According to the Financial Times and also according to analysts, investors and executives in the fintech industry, many fintech companies are now struggling to raise fresh funds and are discussing selling out or valuing themselves less to stay afloat. And as these companies tighten their belts, one can say that a fintech's chance of survival may be measured by the amount of cash sitting on its balance sheet. According to Eric Podzuit, founder and co-CEO of investment company Scalable Capital. Scalable Capital is a German investment company. You are in panic mode if your runway is less than a year, and obviously the runway he's talking about is the amount of cash that is available for your operations over 1 year. Venture capital firms more than doubled their investments in the sector last year to $134 billion, helping fintech valuations outperform any other subsector in the technology space, according to the data from Crunchbase. Funding peaked in the second quarter of 2021 as investors such as Accel, Secure Capital, SoftBank, and Berkshire Hathaway backed firms including Brazilian lender Nubank, German broker Trade Republic, and Amsterdam-based payments group Molly. Financial services companies accounted for roughly $1 out of every $5 in venture capital investments last year, 2021. But now, public fintech valuations have collapsed even faster than declined as funding slowed sharply in the first quarter of this year that ended in March of 2022, and have had a steeper decline than any other technology sector, according to a recent report by Andreessen Horowitz Partners, which cited data from Capital IQ. Valuations fell from 25 times forward revenue in October of 2021 to 4 times in May of this year, 2022. Fintech fundraising in the most recent quarter dropped 21% to $28.8 billion from the record high of $36.6 billion reached in the second quarter of last year, according to CB Insights. Many fintech companies raised capital at lofty valuations based on ambitious growth targets, according to Arjun Kapoor, managing partner at Focus Labs. With all the market changes, most of them are not going to hit the targets they signed up for, which means the business is not worth what it raised. Though he expects the sector will bounce back over the long term, many businesses will get squeezed out in the process. Investors have grown skeptical of consumer-facing digital challenger banks as high inflation lowers how much people can save and increases the likelihood of defaults. Funding to banking fintechs plunged 48% to $4.4 billion in the first quarter of this year compared with the same period last year, according to CB Insights. Many consumer fintech companies in the US have also started to dial back their marketing budgets to conserve cash, according to David Sosna, CEO of Personetics, which provides marketing insights for banks. Bankers are advising companies to conserve as much cash as possible to ride out what will be a difficult 2 years for fundraising. Only extremely strong companies will be able to raise even at the same level as last year, according to a senior banker at a US commercial bank. In addition to a lower valuation, which can be an embarrassing signal to markets and hurt morale internally, down rounds may carry stricter terms. This is according to S&P Global Market Intelligence analyst Tom Mason. Selling out entirely is becoming an increasingly attractive option for many companies. And then when you factor up Apple's privacy changes, this has significantly increased customer acquisition costs, making existing customer bases more valuable. At the same time, fintech companies' valuations are coming down. Fintech acquisitions already are on track to pass 2021 records, and are likely to accelerate through the rest of this year, 2022, as traditional financial firms such as JP Morgan Chase and MasterCard take advantage of cheap software groups. Deals so far this year, 2022, include UBS's acquisition of Wealthfront and Fiserv's purchase of Finxact. What consumers want is the best of what the neobanks have to offer in terms of experience and an ability to get products quickly, but at the same time, what they are going to need in a rising rate environment is the balance sheet of a bank. One investor at a large private equity firm said they received a steady drumbeat of pitches from Fintechs looking to sell themselves in recent weeks, but has so far passed on all of them. And he asked, who is to say this price is really the right price? What if 6 months from now, that price is actually considered too expensive? So see what you make of all of these things going on with fintech companies around the world, and indeed in your country. So thank you very much for watching this video.